Hey, everybody, welcome back to today's Market Explained, a four-star media event, as we like to say. I'm Brian Kasal, your host, and I have a special guest host with me today. We have Mr. Bryan Principe, who is our Director of Marketing at FourStar. And Brian, you're up in, where are you, Brian? You're in Providence, Rhode Island, aren't you?
Yeah, good old Providence, Rhode Island, up here in the Ocean State. The smallest state, but perhaps the biggest heart.
Nice, the biggest heart. That's right, the smallest state, for sure. You rival Delaware for that small state size, don't you, up there?
Yeah, that's exactly right. In fact, even the third smallest state is next door to us in Connecticut. So we have a number of small states up in this part of the country in the Northeast.
Gotta love New England, Brian. Gotta love New England.
Absolutely.
Good. Well, thanks for being with us today, Brian. We have
Pleasure to be here.
have a full regime of stuff we need to talk about, everybody. So we're going to do our traditional review of the economy and the markets and talk about what's happening. We just did that recap on the election, the podcast episode that just came out with Ken Roberts. And we're going to do a little bit more election talk here because we're seeing a lot of changes just in the last 3 weeks now since the election, and it's interesting the changes that are being made. So we'll go through that. But Bry, in the meantime, do you have the numbers on where we are with the 6 asset classes since the last episode of the FourStar Today's Market Explained?
Sure thing. Yeah.
All right, great. Great.
Yeah, love to. So let's take a look in the asset classes here. So if we start off with domestic equities, it's still in the number one position. It's at 331 as a tally score, which is up 7 notches from last time.
Great.
While international equities is at 231, down 9 positions.
Okay.
So pretty big movement there. But we have a really big movement in commodities. It's at 220 and it's up 8. It was at a point where commodities was at 256, so it was fading, but maybe now we're seeing that it's recovering a little bit. So cash is at 132, which is down 2 slots. Currencies holding in at 91, down 3. And fixed income, is at 84, down 1. And just as a note to everyone, its low was at 65. So it's still, ways off from that, but, still something to keep an eye on to see if it will continue trending that way.
Yeah, so Brian, fixed income is still in way in the back, and we have not seen that in all the history of working with these different asset classes. Fixed income, generally has been reasonably good, although cash currencies and fixed income are the safe bucket. So when the markets are running, they're usually 4, 5, and 6 in some fashion, and then domestic equities, international commodities are usually 1, 2, and 3 in some order, and that's kind of where we are. So we're in a bull market still. So it's kind of orderly, but fixed income has been really down after the complete drubbing in 2022. There hasn't been much recovery there. So currencies are better than fixed income and been that way for a while. And all currencies are is cash in someone else's country, right? So our cash, then their cash, essentially. And the currencies are gaining on U.S. cash as we're seeing international markets doing better. And curious, Bri, to say the commodities are up. That's been all precious metals, right? We've seen a big move in precious metals, and then we've seen a huge move in Bitcoin too, haven't we?
Yeah, right. And I don't think Bitcoin, you correct me if I'm wrong, I don't think the cryptocurrencies are included in that, but it's interesting to see that they're also rising too, along with commodities.
That they are, exactly. And then domestic equities were starting to fade, but now they're up again 7 points in this latest since the last episode. So quite curious. When will it end? We're at 22 times earnings in the history of the financial markets, or at least recorded history since 1925. The highest multiple ever was 23 and a half on expectations, and that was back in 1999 when the last big tech boom. And we're going through a tech boom. We had a little stutter step earlier in the year, but it's come roaring back. We'll see that in the sectors later on. But the fact that tech has been running and we had a high multiple, what followed that tech boom was a big tech crash. So we hope that doesn't happen, right? It's
That's exactly right.
entirely possible. But Brian, the other thing that could happen is now that the economy, the economy's kind of fading into recession, but some of the earnings are actually going to be ratcheted up because some of the regulations and new policies of the administration. So if they raise estimates, and will make the multiple of the market go down, and maybe we won't be at such a high multiple because the earnings numbers will go up relative to the current price, right?
Oh, okay.
So
Yeah, that would be helpful.
so then the market isn't completely overbought, right? People think the market's overbought, but it keeps going up. So,
Yes.
so we'll see where that goes.
We'll see how much more buoyancy is left in the market.
Right, and we're just off new highs right now. In fact, here's some numbers, Bry. So the Standard & Poor's started the day today, and we're in that Friday right after Thanksgiving. So it's a holiday shortened day. The markets will close at 1 p.m. Eastern. But we started the day at 59.98 off a one-day pullback from the all-time high on Thursday on Wednesday. But the S&P is up 25.76% year to date, so a big year, and it's up 11% since July 1. So
Those are big numbers.
Big numbers, right? Now the Russell 2000, which is a small cap index, is at 2426. And by the way, the largest constituent now of that index is FTAI, which is an electronics and aerospace company that we happen to own, ironically. And we've ridden that stock up almost 500% in our portfolios. And also, ironically, the Russell 2000 doesn't have 2,000 names anymore as companies get bought out. So they'll reconstitute. They will reconstitute the index again shortly. But for now, there's only 1,954 names in the index, which is kind of curious.
If that doesn't roll off the tongue as well.
No, it doesn't. But it's up 19%. But all of that 19% was done since July 1. So then small caps have been stronger than large caps since July 1.
That's interesting.
Yeah. And then the Dow Jones is up 18.6. So not as much as the S&P, but 14% of that is also since July 1. So since July 1, the Dow Jones, the dividend stocks, and the Russell 2000 small cap stocks are beating the large caps, interestingly enough. So in the short-term trends, leadership is shifting, and we're seeing a little bit of that. Brian, we've also got the Morgan Stanley EFA index, which stands for Europe, Asia, Far East. That's up only 2.61 year to date, but ahead 12%. Since July, it's down 1.13. So it was up 12%, and then it had a 10% pullback. So it's down 1% since July 1. So international stocks are fading a little bit. And the emerging markets are up a little bit more, up 6.24 year to date. Had gotten up to as high as 14% in early October, but it's back down to flat since July 1. And then the other, the other big index we talk about, Bry, is the NASDAQ Composite. That's up 26.97. That's the best index again year to date. It had been up 20. And by July 1, it's only up 6.8. So again, NASDAQ and the S&P are beating everything year to date. But since July 1, it's been all small cap and all dividend stocks relative to the technology and the S&P. So those are the short-term trends. And ironically, in a bull market, volatility usually goes low, and the volatility index, the VIX, is at 13.9, which is a very low VIX index. So that means volatility is low. The markets are rising in kind of orderly fashion. That's classic bull market stuff, Brian. And so our listeners will know that we are in a bull market. They're seeing it in their portfolios. They're seeing it in their statements. Where it all ends, we don't know. But right now, according to the work we have, we're fully invested in the portfolios and haven't taken any protection right now. But if we see a little bit more distortion and the market starts selling off, we'll start to be more protective. So that's our posture right now. But Bry, didn't you come up with what the best sectors? There's 11 sectors in the S&P. What are the top 3 and what are the bottom 3? Do you have those numbers?
Yeah, sure. So I thought this was interesting, and maybe not a surprise, at least in some of them. But as you're saying, of the 11 sectors in the market, the top 3 currently are communications, which is up over 33%. Technology, up almost 33%. And this is one I particularly found interesting is utilities, up 30%. People think those are, more of like the, tried, almost like boring sort of, sector. It's your power companies, right? And utility companies. But, you're seeing a pretty good run up here. In fact, a lot of them have, also pay out in a lot of dividends too. But to also see the 30% rise so far as a, performance this year, I personally found that to be interesting.
Yeah.
Um,
So why are utilities up along with that tech and telecom? I mean, but it makes sense. So because the interest rates have gone down, we've seen two Fed rate decreases, a 50 basis point and a 25 basis point. So that helps all the debt-laden companies, like a lot of debt on utilities, dividends and everything. So that makes sense. Although you're right, Brian. It is very unusual to see tech, telecom, and utilities in the top three. Utilities usually don't react in a bull market, but they are because of the interest rate environment.
Interesting. Okay, well, that makes sense when you put it that way. It really
Yeah.
does. So, now let's look at the other end of the spectrum, right? So, the bottom three are the worst performing sectors in the market right now are real estate, which is still seeing a 12% rise, by the way. So
Still positive. Yeah.
we're talking about, as you point out all the time, we're talking about relativity here, right? So the relative strengths of things. And then we have basic materials, which is, up just below 10%. And then healthcare, which has been a star before, is, really a laggard here, up about 7.5%.
Mhm. So it's still positive, but during the COVID era, the government spent so much money in healthcare, and those stocks ran like crazy, and Pfizer and all the Moderna and all those names, and now they've come back down to earth. So that could be still kind of a COVID hangover, that the healthcare stocks are fading now, and there's not as much spending on them as there was for a couple of years there, right?
Yeah, I mean, that's what it, seems like. It's just definitely interesting.
So there's always the tug of war, Brian, between growth and value. And while we're seeing the value stocks do a little better, the financials, the utilities, names like that, it's still been a growth market. We had, like I mentioned, the first quarter of this year where the growth stocks didn't do as well and technology underperformed the S&P, but now they're coming roaring right back, right? And although still in the short run, we've seen the small caps and the dividend oriented names starting to recover. That's why utilities are up there. Financials are right behind utilities, meaning all the banks and financial companies, non-bank financials, that kind of thing. So growth is still in charge, with value is gaining on growth. So we'll see those trends continue. And then also, Brian, I just wanted to mention, the Magnificent Seven from last year, and that was a big thing where those top seven stocks that dominated the S&P. Well, that's kind of faded now to the Fab Four. So a couple of those names like Tesla weren't doing as well. And so,
Gotcha. Yeah.
Nvidia stalled and kept going, and then semi-micro SM cracked, and so some of those stocks faded away. So if you're lucky to have had those seven last year, you did very, very well. But there's a huge divide between the index and the individual names in the index. So if you were having like a balanced portfolio, you didn't do as well. You had to be way overweighted in these aggressive tech stocks, which is a risky position to be in. But frankly, that's the way the index was. The index, we think, got very speculative there for a period of time. And so that is kind of reorganizing itself now, Bri, where the dividend stocks are doing better. So there's a broader mix of stocks working and not just technology.
That's interesting. I guess, that's sometimes when people are looking at, let's say, a market weight of an index versus an equal weight.
Mm-hmm.
And what the percentages are of the various companies that, might make up that index, right?
Right. And so the equal weight is still lagging the market cap weighted index this year, but not to the degree that it did last year, right? So now, so the dividend stocks are starting to work better. All the banks and financials are starting to work better. So we're seeing a broadening of the performance in the markets as compared to last year, when it was all tech names, really is what happened. So
yeah, okay.
And for those who have been around a while, might remember that investors got slaughtered in tech in 2000 to 2002, after like a 4-year run of technology. Markets finally bottomed in July of 2022. I remember I was on a golf course fielding calls in the last week of July, and the emotions were very high, and the former tech names were cratering and gapping down very quickly. So you knew you were near a bottom. We are obviously the opposite of that right now. We're right near the highs. But just as we're sitting here, things like that can develop. And so if that were to develop, we would watch very closely and take some protection. And another example of how things could fade. We had one client that wanted to invest in technology, and we were really scared of technology at the time. And so he ended up buying a small amount in a net fund, and it went down 90% actually at one point. But he wanted,
Wow.
he thought he thought it was going to recover, and he wrote it all the way down. It's very unfortunate. But that's how tough things can get when things get bad. So we have to be careful that if technology slows down, we have to be ready to take protection. So the FourStar protection plan is clearly in place there, so we don't get caught into a bear market like that one investor did. Right.
That makes all the sense in the world.
Yeah. So the themes now, the healthcare and materials and the dogs will have their day. Another strategy has been to buy the dogs of the Dow, and that worked for many, many years until it became popular. And then all of a sudden, people started to game the dogs. So if you saw stocks that were ending the year as the dogs, they would start to rally in December. So people were buying them in the fourth quarter and not waiting till the end of the year. So the dogs of the Dow strategy didn't work very well. If you were following that strategy, you'd buy those bottom three sectors, Bry, that you had talked about, the materials and the healthcare names. But maybe those strategies don't work anymore. That was some way to play it. Right. And then also in the markets here, we're seeing some distortion in retail as there's numbers in the economy that are not positive, but yet the GDP numbers have been strong. So how could the GDP number be strong, yet employment and retail sales and all those numbers are not coming through that well? Well, the missing factor here is that in gross domestic product is all the government spending as well. Anybody who took the basic economics course, GDP is C plus I plus G, consumption plus investment plus G is government spending. So we've been 2 trillion of deficits now for at least the last 3 years, and then 6 trillion in the last year of the Trump administration, because that was the COVID year, and that was a spillover into 2021. We cannot keep running these deficits, but the new administration is coming in, and incoming President-elect Trump has assigned Elon Musk and Vivek Ramaswamy to this DOGE committee, and their job is to cut spending and get us back down to no deficits. If they do that, then that 2 trillion in deficit will go away, and that GDP number will go down as well. Right.
Well, right. Obviously, like you said, I mean, that's a huge component of what the GDP is. And, it goes right in line with the latest leadership matrix post that you released today, that really talks about that precisely, and how, this deficit spending is really unsustainable. And I think one of the points that I got out of that post is, the economy is so good. Why are people feeling a bit glum about it? Right. And you mentioned that in there, right? You talk about the consumer sentiment survey numbers, which are low. I think 100 is baseline. Anything above that is positive sentiment, and below that is negative. And it's at something like 77.5, if I remember what you had listed in your article correctly. And even you had referenced an article that was written in the Wall Street Journal before the presidential election, talking about this sort of subject. And that article references a poll in the Wall Street Journal that says 68% of Americans are feeling that the economy is not so good or poor. So, it's almost like, we were talking before on how much more resiliency or buoyancy there is in this market. But I think folks might be seeing that there could be, upcoming storm clouds, and there's at least some concern about that that's being reflected in, these sort of surveys that you reference in your leadership matrix post.
Yeah, and Brian, we've had inflation, we had rough inflation for about a year and a half, and it's come down, but it's still there, and people are still feeling it in their pockets. In fact, whenever the economy is weak and investors are concerned about spending and they've cut spending and retail sales are weak, then it shows up in elections, right? So usually when the economy is bad and the investors and folks in the economy are unhappy with the economy, that's when the party in power usually takes the brunt of it. And so there was a shift from the Democratic Party to the Republican Party, as a lot of people cited the economy as their biggest reason for voting. There's other reasons they voted for, the change, but the border and other things. But it's been primarily the economy, and that's what people cited. They're not happy. Food prices are up. Everything is up. Gas prices are up. And so that's really is what affected everybody in this recent election.
Yeah, I think maybe a lot of people were asking themselves, the age-old question when it comes to a presidential election, are you better off today than you were 4 years ago?
Right.
And unfortunately, a lot of people are answering that they're not. It doesn't mean that there isn't hope for change or, getting better, but you hit it on the head. I mean, the spike in inflation that we saw, although it may have come down in rate, it's still a smaller increase on a large increase that was there. So prices haven't come down. It's just that they're going up at a slower rate than they were before, and it's affecting people. People need to make their household budgets stretch further, and I think everyone to a degree feels that. And
Right. And we'd have to have deflation, meaning the prices would have to go down for a year or two to get them back to where we were in 2021. And that hasn't happened. So as you say, the rate of increase has slowed, although we're still above where we need to be on that as well. But prices would have to actually come down to get us back to where we were before.
Yeah. So so I think you hit it on the head there. In fact, you talk about elections having consequences, and the incoming administration is talking about imposing tariffs. And I think a lot of people were thinking that it might be a higher sort of tariff rate on a country like China and a lesser tariff rate on countries like our neighbors, Canada and Mexico. But what we're hearing right now is that there, could be as much of a 25% tariff on Canada and Mexico trade. But part of the thing here is, to stop sort of, the illegal border crossings, as well as the whole fentanyl sort of flow of fentanyl drugs that are coming in. So yes, it would raise revenue, and hopefully, especially in the fentanyl crisis, affect and seriously, diminish the amount of fentanyl that's coming in across the border. It sounds like, and look, none of this is in place yet, so a lot can happen. But so far, Justin Trudeau, Prime Minister of Canada, is, seems to be open to dialogue about that so far, about the tariffs, whereas the president of Mexico, Claudia Sheinbaum, who, by the way, is the first female president of Mexico, and someone, I have two daughters, and so I love seeing, women really, breaking any sort of glass ceilings that are there. She was a bit more combative. She's like, all right, if you want to put tariffs on Mexico, we're going to put tariffs right back on you. And so, be curious to see how things play out as, these sort of policy ideas turn into policy sort of efforts. But at the same time, he's talking about, tariffs on China at 10%. And personally, I feel like he might be starting at 10%. It's something that could be ratcheted up depending upon how they respond. But one thing that we've seen from China is that, there's a lot of homegrown Chinese auto companies that are really growing at a real fast clip. And, it's starting to threaten established auto markets, not just in the US, but in Europe. And although there's still a good sized tariff on the import of Chinese automobiles, so Chinese made automobiles into the US, some of the biggest Chinese manufacturers we're talking about maybe setting up plants in Mexico to get into the US market, right? It's a backdoor into the US market. which is the most valuable auto market on the planet. It might not be the biggest in unit sales, but it's the most valuable. But there's already been announcements that any ideas so far of Chinese auto plants being built in Mexico aren't moving forward, at least for now. And that's probably a positive for the domestic auto industry.
It is. So just by jawboning, it looks like once again, President Trump is getting people to make economic moves, right? So politics always affects economics in that sense. So if the Chinese aren't building cars in Mexico or building plants, then that creates less competition for the Americans if they're closing the border and all those things. So at least some of those things are positive, and those are some things that some of the voters did cite concern over the border. But again, I think the overriding thing really was the economy and inflation and how it's hurting people in their pocketbook, right?
Yeah, I think that's probably exactly right.
Right.
Yeah.
Well, so we'll see what happens with the tariffs. Trump, as a president before and then now again, does lead more to the bluster side of things, right? So he'll say things just to rile people up, and then they react, right? And even you see it in his cabinet picks, where one day he'll announce a cabinet pick that is going to satisfy one side of his party, and then he'll announce a cabinet pick that satisfies the other side of the party, keep everybody guessing. And that's what he's doing with the tariffs, it looks like. But he is getting Canada and Mexico to react. He's getting China to react. And so and it's all about, trying to keep the American economy strong, I believe. So.
Well, yeah. And you know what? One more thing I may mention about manufacturing in general, and if any of this helps domestic manufacturing, okay? So the manufacturing sector has the highest economic multiplier of any industry. Okay, so for every dollar that's spent in domestic manufacturing, you see about a $3.60 sort of ripple, a multiplier of dollars spent in additional value in the economy. Mm-hmm. So, it's really a way to kind of leverage sort of output and value in the economy if more of it is spent on domestic manufacturing. So if we get any increase in domestic manufacturing because of any of this, it can really help provide a good positive economic ripple effect in the overall economy, and Absolutely. Greater than any other economic sector.
Well, Brian, you see that in the state of Michigan and Northern Ohio. So if Detroit is the leading city for the auto industry, all around within a few hundred miles circumference of Detroit are all these smaller cities with tons of parts makers and component makers and all. So there is a huge multiplier effect, as you say, just from auto manufacturing in general. So I think Trump is trying to bring back manufacturing more to America by blocking some of the people who would undercut our pricing.
Well, there's been plenty of people who have talked about ways to, strengthen domestic manufacturing, and I look forward to, any policies that are going to help do that.
Exactly. Well, and then we see it too, and more kind of moves that are made by political moves causing economic moves. So most folks enjoyed turkey yesterday at Thanksgiving Day. So now we're into the Thanksgiving weekend. And most folks don't realize that Minnesota is the largest turkey farm state. There's 600 turkey farms. And so they are struggling though, however, partly because the largest state in the union, California, created some regulations for requiring that any chickens and any other animals and turkeys that are imported into California, that they're raised a certain way, that there's more room for live chickens and other animals in the farms. And so if it's not that way, then California won't allow those live or those animals into their state. And so even though it's not a Minnesota regulation, it is a California regulation. They've also imposed some new wetland regulations in California and then in the state of Minnesota as well. So it's affecting some of the costs in Minnesota, even though the California rules are just California, but it affects Minnesota anyway. So it's not just, federal regulations, it's also state regulations affecting the economy. So anyway, the turkey trade is in a little bit of trouble right now because of some of those regulations, Brian.
Wow, interesting.
Another one of these things about, elections have consequences. So the head of the Teamsters Union, for the first time, went to the other party's convention, and that would be the Republican convention. Normally, that union had always, the UAW had always backed, and Teamsters had always backed the Democratic president. This time they didn't endorse. So some of those things are changing. The new labor secretary is a female member of Congress, former female member of Congress from Oregon, who is pro-labor. So business unions are now trending to the Republicans, and Trump is close, of course, with Sean, the president of the Teamsters. So labor is now, trending in a different direction. So there are things that are changing in the economy and different political groups. Now the unions are starting to side with some of the Republicans. Of course, the public employee unions are still with the Democrats, but you see how some of those things change in the economy by different regulation and different alliances within the political world also then affects the economic world. So.
Yeah, that's really interesting. In fact, you mentioned the Teamsters president. Sean O'Brien grew up probably 20 miles north of me and built his career in Boston, which is literally about an hour north of me from here in Rhode Island. And this election season, I made it a point to watch both conventions, and so I did see his speech at the Republican convention, and I was curious to see if he was also going to speak at the Democratic convention, which as you mentioned, he didn't end up doing. But yeah, I mean, that was part of the dynamic in this too, in that the Teamsters, they're a large, historical labor union who have traditionally endorsed the Democratic ticket, and this time just didn't give an endorsement. So it was interesting to watch how that played out this year.
Yeah. So again, politics affecting economics, and so we'll just keep watching the economic trends and see what happens. In fact, I want to run through this past week, if I can. So nothing really happened on Monday except Austin Goolsbee, the head of the Chicago Fed, spoke. Tuesday, we had the Case-Shiller index come out, and the forecast was 4.8. It came through at 4.6. Used to be 5.2. So the real estate index is slowing down. Consumer confidence forecast 111. That was in line, and it's actually a little bit better. So some consumer confidence numbers are coming back, but new home sales were down. Their forecast for 725 was only 610,000 new units.
Wow.
38. So that's going lower, Bry. The Fed minutes. Now the Fed came out with minutes on Tuesday. They talked about the neutral rate, where they believe that's an equilibrium for the economy. They believe to be about 3%, but many are starting to believe that rate is higher. Right now, the Fed funds rate is 4.5 to 4.75. So if 3% is the natural rate, then they would be too high. But now folks are thinking that the regular rate should be neutral rate, should be higher than 3, maybe into the 4 range. So maybe we're not too far off. Personal consumption was at 2.1%, now expected to rise to 2.5%, however. So the target inflation could be going back up, and that's what people were worried about. They're also worried about the Trump tariffs. This is what the Fed says. And deportations could exacerbate inflation. So if that's the case, they couldn't really lower rates because then they would make it even worse. So they may just be stuck with rates right now. They can't really go lower, but they don't want to go higher. But if inflation comes back, they could go higher. So we talked about that a number of times. I think the Fed in their minutes this week is talking about that. If inflation were to turn around and go back up, not only would they not go down, the 2 rate decreases that they did this fall, they may have to double back on those and raise rates again. So hopefully not. That would be a bad scenario. That's what happened in 1981, 80 to 81. Where rates got lower, but then they had to raise them quickly again as the economy went back into inflation. After they thought they had whipped inflation, they didn't. So it doesn't happen again here, Brian.
That's for sure. You can say that again.
Yeah. And then Wednesday, initial jobless claims came in a little bit light, 213 versus a forecast of 215. Durable goods was forecast to be 0.5%. It was only 0.1. GDP numbers, 2.8, that met expectations. Again, we believe that's primarily because of the government spending, that if they stop that spending, the GDP numbers could probably go down. And then the Chicago PMI manufacturing index is at 40.2. Expectation was 44.9. Anything below 50 is contraction in manufacturing. So I think the incoming administration is trying to get those numbers back into expansion by making some, of course. So we'll see what happens there. So all the metrics that we're announcing are either neutral or negative, and the GDP has been positive. So that's the only thing holding up. The GDP could go lower by government spending going away, and then we actually do have that long rumored recession. We've been predicting a recession now for 6 months, every month for the last 2 years, and it hasn't come. And that's, I think, because of the government spending, which if that goes away, then we do go into at least a recession, right? Maybe a mild one, but nonetheless a recession. So then Friday today, only releases from the Commodity Futures Trading Commission. So nothing really of consequence. It's a shortened day today. Next week, we're looking for consumer construction spending, the ISM index and factory orders. Those have all been contracting. We'll see if those numbers continue. And then unemployment went up to 4.1, and the U6 unemployment, which includes marginal labor, was up to 7.1%. So unemployment going back up, right? That's also a sign of recession. So we'll see how things play out. We've had a lot of interesting changes in the economy. And now, as a result of some of the concerns of everyone, we had a shift in political leadership again, as people were not happy with what went on. As you said, are you better off now than you were 4 years ago? And a lot of investors and a lot of voters said, no, we're not. And so they made a change. So we'll see. We'll see what the new administration can do.
Yeah.
Brian, also, you know, what we see out there culturally, the two of the top songs in the last 18 weeks are both complaining about the price of gas and inflation. So it's in the lyrics. And then also, folks might remember about 18 months ago, one of the biggest songs and one of the hottest songs in America was "Rich Men North of Richmond" by a folk singer in Virginia, south of Richmond. And he using, for whatever reason, using Richmond, Virginia as the linchpin. So everything north is considered to be Washington. And
I say
complaining about Washington, right? So it's in the culture. People are feeling it. They're feeling inflation. They're feeling the economy slower. And so that's, you know, we're seeing it in the culture as well as, you know, in the actual.
Hey, you know, one thing I think we'll be seeing no matter what. I mean, as you mentioned, today is Black Friday, right? And so it's the start of the, you know, holiday, at least the unofficial start of the holiday season. And as you've mentioned in prior Leadership Matrix posts, you've talked about the top holiday song. You know, Mariah Carey's "All I Want for Christmas" is You, right? It keeps coming back and hitting the top of the billboards. Although I think, if I recall correctly, you had mentioned how Brenda Lee's song, "Rockin' Around the Christmas Tree," made a run for #1 and maybe even hit #1 at some point last year. So, you know, yes, gas prices affect me every time I'm filling up my tank, but I think we're going to be seeing these holiday songs coming on top of the Billboard charts, given the time of year we're in.
Yeah, exactly. Well, good. Well, I think we covered it. Also, folks, don't forget the previous episode. We did a deeper dive on the election. Ken Roberts was our guest on that show, and Chris Reardon.
Today's Market Explained.
Today's Market Explained. Chris Reardon, our regular co-host, will likely be back for the next episode. But Brian, we really appreciate you joining in with us and filling us in on the economy and the markets and the sectors and the things that you see. We appreciate that very much.
Brian, thank you for having me. Really appreciate it. And I wish you, your family, and all the listeners' families a very happy and healthy holiday season.
Yes, thank you, Brian. I think that's right. Thanks, everybody. We hope you had a great Thanksgiving. We're going into the holiday season, so we hope everybody has a good period here and enjoys with your families and everything else. You know, we'll see how the economy develops. We'll be back in a couple of weeks with another great episode of Today's Market Explained, and we'll give you an update on what we see between now and then. So that's all for now, everybody. Thanks for being with us again on Today's Market Explained. We will be back soon with a new episode. Thanks so much. Over and out. Thanks, everybody. Bye-bye now.
Thank you.